Okay, everybody, thanks so much for coming. I thought we'd get started. You're not going to find a sophisticated or elaborate model here. You're just going to have a discussion about some policy issues related to financial stability. And the thesis is there's a lot of work to do. There's a lot of unfinished business. And I'll tell you why that's so. Feel free to interrupt, ask questions. I come to this obviously with a background both in business and in government, but also thinking deeply about these issues for quite some time. In fact, the origin of this talk really started in 2018 when I was asked to go to Vanderbilt to give a talk on making markets more resilient. Morgan Ricks, Yasha Yadav, both in the law school there, asked me to give that talk, and I argued then for at least one measure that we've already put into place, namely a standing repo facility, but not so much for what the Fed wanted, but primarily for financial stability purposes. And you'll see why that's so needed today. So the summary is unfinished business. As you all know, banks are much more resilient now than they were before the great financial crisis. We've done a lot of things in Dodd-Frank and other things around the world to make them so, but non-bank financial institutions and the activities in which they engage, and what I refer to as systemically relevant markets, you could call them systemically important markets, aren't. And it is the case that when we regulated the banking system more appropriately, we experienced what you always experience when you regulate one part of the financial system and don't regulate the rest of it. Regulatory arbitrage has promoted a migration of risk to the less regulated terms of markets. So we need really a holistic approach to building resilience across the financial system. If there's one lesson we learned in the great financial crisis, it's that it is a system, and often we find vulnerabilities in the weakest parts of that system, and that we need to address these urgently. We need to do so because there are lots of pockets of vulnerability, and we need to do so because on top of all the other things that we're dealing with now, COVID certainly isn't over in China, and the war in Ukraine has reminded us of geopolitical risks, among other things, and we are seeing as well increasing evidence of climate-related risks that Rob and I spend a lot of our time thinking about. So on top of all these things, the last thing we need is another financial crisis. Let's step back and talk about what we mean by resilience. From my standpoint, there are two aspects to it. One of them you're pretty familiar with, and that is the ability to absorb shocks. No question. We want to make sure that the system has enough shock absorbing capacity so that it can still function even in periods of stress. And we haven't done such a bad job for the banks on that score. The second is, however, our incentives align so that we see less or more market discipline, I should say, and transparent pricing of risk, so that people don't engage in excessive risk taking. Now, that may be in the eye of the beholder, but it's pretty clear to this group of finance and economics professionals that incentives matter, and they clearly matter when it comes to thinking about risk taking. If the price of risk goes up, then you may take less of it. So both of these are important. Shock absorbers are important to buffer loss. Guardrails or incentives are important to constrain behavior, to increase the cost of and constrain risk taking that can create financial vulnerability. I'm sure you're all familiar with the concept of too big to fail. Market discipline and too big to fail really are almost synonymous. If we have market discipline, then people won't expect to get bailed out. That's not limited to the banks, as we'll see in just a moment, because what we've seen is that banks and non-bank financial institutions, as you all know, engage in maturity, liquidity, and credit transformation. And all those things can create benefits, but they can also create some risk if engaged in to excess. Now we know the banks are more resilient. They've got micro-prudential regulation. We've got supervision of the banks. We understand what they do. Part of the supervisory process is to have stress tests, and the stress tests reveal the extent of capital loss in the event of shocks. And that's become a workhorse tool for supervision. And it's become a workhorse tool for banks themselves to help identify how resilient they are in the face of either hypothetical or historically based shocks. We also have regulation that outlaw or at least resist and lean against certain kinds of behaviors. And they have both shock absorbers and to some extent guardrails. Non-bank financial institutions, much less so. The regulatory arbitrage has promoted more risk-taking in those parts of the financial system. And according to the Fed's latest financial stability report, which came out early this month, hidden pockets of leverage exist across the financial system, which may create vulnerabilities in the event of a shock.
Can you give us some examples? Those hidden pockets?
I can. So open-end bond funds, for example, which use leverage to juice returns. Now, most of them are simple, on the asset side of their books, they have the collateral. On the liability side, they have the investors who invest in these funds. But to the extent that they may use leverage to boost returns, that's where some of these hidden pockets may exist. Hedge funds engage in leverage that is often unseen, even though we started reporting what hedge funds are doing, what their leverage looks like on so-called Form PF from both the SEC and CFTC. But the reports are quarterly, and quarterly reports uncover window dressing at the end of a quarter. So we may not see all the leverage that's there. Private debt and private equity, for that matter. Through the period of low interest rates and cheap credit, we saw valuations for private equity and private debt that were based on looking not at debt to EBITDA, but debt to valuation. A circular process that encourages more risk-taking. When the values go up, courtesy of the market, then your debt to valuation looks even better and you can take on more debt. And so those are three examples of where there may be some hidden leverage, and there are others. Now, for banks, we all know that in the wake of the financial crisis, capital requirements, which were quite low, these are common equity tier 1 ratios, and they're based on accounting. If we really measured these things accurately, in the sort of run up to the financial crisis, there were some banks who had capital ratios that were less than 1%. And if you take the inverse of a capital ratio, you know that that implies a lot of leverage, like 100 to 1 in the case of 1%. Here, what you see is ratios that were dipping into the 4 or 5% based on accounting measures, and they've dramatically increased in the wake of Dodd-Frank. These are U.S. banks, and there are 4 different flavors here. Jacob?
Richard, when you said before that risk migrates to less regulated areas, what did you mean as the remedy? To do the regulation better or to extend the regulatory authority in some areas?
So you're going to see that the remedy is to level the playing field and to make sure that we have appropriate regulation for the less well-regulated parts of the financial system.
But still, let me understand. Is it that the current regulators don't do their job right and you want to tell them how to do it right? Or you want to have like new legislation that expands the regulatory authority into other areas?
It's some of both. So just to keep the answer short, because we're gonna talk more about this. To the point that they don't do their job right. You know, having lived in Washington and worked and run a federal government agency, I can tell you that you don't do things for which you don't have authority. And the SEC and the CFTC, our market regulators, have certain authorities, but they lack others. Neither have a financial stability mandate. So they don't worry about financial stability from an official point of view. They should. They are both members of the Financial Stability Oversight Council, which is a loose group of regulators that gets together and talks about these things. But when push comes to shove, they don't do anything about it.
But do they do the maximum they can within their jurisdiction?
Not in my opinion, no. But they also lack authority to do certain things. So if you think about spillovers from one part of the financial system to another, they are not charged with building resilience. They are charged, in the case of the SEC, with investor protection and fomenting and fostering capital formation.
I know, but what I'm saying, when you propose what to do, will you say whether they should do it within the current jurisdiction or whether it requires expanding their?
The answer is both. The answer is both. And we're going to see that in the discussion. If you want to put in these terms, Yaakov, they are not paid to go outside the narrow lanes in which they typically operate. Right? Now, you might say, well, Gary Gensler is an exception to that. He seems to be doing regulation by enforcement. Why is he doing that? He doesn't have the authority to promulgate certain regulations. So after the fact, like closing the barn door after the horses are left, he is trying to enforce regulations that he believes are appropriate for certain kinds of activity. And he's being much criticized for that because he's stepping outside of what many people perceive to be his lane.
But even if the SEC had a mandate similar to what you're advocating in terms of financial stability, they took it very seriously at all times, regardless of who the president and the Congress is at that time. Are the non-bank financial institutions that you're concerned with, and I think many of us are, regulated by the SEC as to their risk? Such as, I know mutual funds, they're all the time dealing with SEC. Probably many other types of funds, but I'm not so sure that a non-bank private lender is under the jurisdiction of the SEC in any material way.
Not in the way that we would think would be appropriate.
Is there any institution, maybe I'm getting to your punchline, but are there any institutions that have the authority and let's see the responsibility of monitoring the leverage and risk taking of, for example, the hedge funds that you're talking about, the BVT.
So the hedge funds, Ed, to your point, hedge funds do have to report if they're above a certain size. And if they are above $1.5 billion in assets under management, they have to report certain aspects of their activities, including leverage. But the problem is that the reporting is quarterly and it's based on end of the quarter reporting, which encourages window dressing. So during the quarter, you don't see a lot of the leverage that these hedge funds are engaging in. Furthermore, they don't report in many cases on a complete basis their derivatives positions. And as a result, you don't see all of the leverage that might be involved from the use of derivatives.
And if they reported everything, according would the
That would be a good step,
would the
but not
regulator
sufficient.
have the ability to say that's too much?
They don't have the authority to say that.
Like the Fed put in, for example, a maximum of 6 times debt to EBITDA as more or less a working constraint on the amount of.
On leverage lending. And how did that work out? It was not, there was no mandate, there was no requirement. It was simply guidance. It said the Fed will frown on you for what that's worth.
Yeah.
And so what happened was the leverage lenders simply did their activities and you know, from scrutiny.
Well, getting back to my point. Is reporting the same thing as a constraint?
No, reporting is useful. Sunshine is a good disinfectant, but it's not sufficient to eliminate the problem, right? So that's important. Rob?
So you started with two descriptions of what you meant by resilience. One is basically, I think, all of this. The second is incentives to align risk-taking with what social welfare function might be. We think the risk-taking ought to be. Is the solution to this to somehow focus on the second one? And if so, how do we do that?
I think the answer is you need both, right? You need both the shock absorbers and you need the incentives. And for banks, as the headline indicates, I'm going to hide this floating headline. I think the headline is telling, because when you raise capital requirements, you reduce the intrinsic leverage in the institution. I mean, think about it. Banks are massively short options and they are heavily leveraged. And the reason they don't blow up all the time now is that we have supervision and regulation that governs their activities. We have, you know, all those things and certain things that the banks are supposed to do. And we have explicit guidance on their risk management. But we don't have those things for a lot of the non-bank financial institutions. We don't have the non-bank financial institutions reporting what they do as opposed to just their positions and how they do it. We don't have people going into those institutions and saying, here's, you know, a good way to proceed. I'm not suggesting that every non-bank financial institution be subject to that kind of supervision. But if we don't have the incentives aligned right, then people are going to be tempted to take on more risk, especially because they know that if bad things happen, the Fed will be there to bail them out.
So we're talking about micro or macro?
Both. We're talking primarily about macro pru in the sense that when we get to talking about one of the central problems that we need to address in financial stability, namely that the demand for liquidity has exceeded the supply, that's largely a macro problem, but it has micro underpinnings because of the structure of our regulation, the structure of intermediation, which has also created that mismatch. So the point here is that when you raise capital ratios, you have more shock absorbing capacity and you have a reduction in leverage of the firm. It's a big difference when you have a 12% capital ratio from when you had a 4% capital ratio as far as the leverage is concerned. When I was at Morgan Stanley and I first started working there in 1999, one of my colleagues on the way up to meet with the senior management said to me, "Isn't it great that our multiple is comparable to that of this .com company? And isn't it great that price to book for our firm is like 3 times?" And I thought, I'm not so sure this is all that great. Maybe great if you're exercising your stock options in the short run. And that's good for you because our profitability and return on equity looks terrific. But right now, you know, what we're looking at is something that creates long-term problems. See if I can get this going again.
But my point, just make one point about this and just get your thoughts on that, which is it seems to me that the capital requirement has improved, not sort of in just pure level terms, but the fact that the arbitrage around the capital requirements has become harder with stress tests and so on. And so, there's a floor leverage ratio that at least the depositories and perhaps even the GSIPs have to meet. So, because, most people would have argued that capital requirements were in place earlier before the GFC as well.
Yeah, some people argued that the banks were well capitalized.
Yeah, because I don't think there was any bank that failed because they didn't meet the regulatory standards. It's just that somehow
The regulatory standards
there
were
was just
just,
so much regulatory arbitrage. And so I guess maybe the bigger point I wanted to make was that did we learn the law? Did we miss out on a very big lesson from the crisis, which is that it wasn't so much that just go and regulate banks better, but it was really that if you go for better regulation, you also have to close the regulatory gaps because then the arbitrage incentives become very strong.
that is my point, Ferrari.
That's
That's precisely the point. So as good as this makes the banks look, the gap opened up as a consequence of this, and regulatory arbitrage ensued. Now, I'm not going to argue that the growth of our capital markets is a bad thing. Vibrant capital markets are unambiguously a good thing. And in our financial system in the United States, roughly half, more than half, of private non-financial debt is intermediated through securities market.
Hey, Richard, can you do something about the display?
Who can see this recording? Let me see if I can.
Okay,
How's that?
thank you.
Better?
Perfect.
Good. So securities markets clearly dominate, and the bank share of intermediation has been basically through 2000 or so was on a long-term downward trend and has not really recovered. The sharp-eyed observer here will notice that these numbers don't add up to 100%. And that's simply because there are institutions that are not captured in the flow of funds. These data are from the Fed's flow of funds statistics, or what's now known as the US financial accounts, don't cover their activities completely. And we try to sort of think about the extent to which that might be the case. But they cover like 85%, which is the lion's share of activity. And so what's interesting is that those other things increased in importance around 2002, 2003, 2004, and then that leveled off. But we still have, through securities markets, more than half being intermediated. And some of this, not all of it, but some of it is technology, clearly. I was at Solomon Brothers when Louis Ranieri started securitization of the mortgage industry. And that was a technology innovation that was hugely beneficial because it took all that stuff off the books of Solomon Brothers and enabled them to earn very high returns on originating those securities. But that's not the whole story. Regulatory arbitrage also played a role here in these changes. In other financial systems, like in Europe, for example, they are more bank-centric. But Europe is now trying to grow its capital markets in the so-called Capital Markets Union. And frankly, having both vibrant markets and a vibrant banking system are good things. But we have often confused vibrancy in peacetime with resilience. And that's not necessarily the case. So my friend Paul Tucker has a lot to say about regulatory arbitrage. And, one of the things that he says. You're going to tell us who Paul Tucker is? Oh, sure. Paul Tucker is the former deputy governor of the Bank of England for financial stability. Now teaches episodically at Harvard and is the author of a few books on this and other topics. And the basic point is that the growth of so-called shadow banks, or what often people call market-based finance, has been in part the result of tightening banking regulation. We haven't done enough to level the playing field, and we need to think about what that should look like and what that means. So some examples of regulatory arbitrage, clearly money market mutual funds are one such, which arose during the period when we had rising interest rates in the United States, but limits on deposits at banks. And so the money flowed out of banks, and where did it go? Went into the Eurodollar market. And then we institutionalized that with money funds. And we still have that. And what we saw both in the great financial crisis and in the pandemic shock, that these were runnable. We saw so-called special purpose vehicles and special investment vehicles be subject to vulnerabilities in both of those. We saw repo intermediation, which is collateralized, obviously, as you know, subject to runs. All these activities were to some extent the result of regulatory arbitrage and the growth of capital markets. And all of them, or many of them at least, are runnable. That means because they may involve a maturity mismatch or a liquidity mismatch, or for that matter, a credit mismatch on both sides of the balance sheet, that investors in these funds may seek to get out before the rest of the crowd does. And we saw that in money funds, we've seen that in other areas. We haven't yet seen it prevalent in open-ended bond funds, except in the wake of the pandemic shock, we did see some of that. So open-ended bond funds promise daily redemption, not at a fixed price, but at the current price, whatever the NAV is, at the end of the day. And people who anticipate that rates are going to go up may want to exit open-ended bond funds, which have long duration assets and short-term liabilities. So that's a feature of some of these developments.
But Richard, when you say runnable, run on the banks lead to bankruptcies and widespread crises. A run on a mutual fund that holds treasury bills just inflicts losses on the holders, but there is no run issue.
Well, Yaakov, I beg to disagree.
Why not? Why do you
Because
disagree? Suppose there is a mutual fund that holds treasury bills and they yield and people dump it. What will happen?
so if they hold treasury bills, then that's typically less runnable than other kinds of so-called prime money market mutual funds. Prime money market funds, which typically held commercial paper and other short-term assets. And they were allowed to do that under the regulations.
Okay.
The question was, what was the value of those assets in a risk-off environment? The value declined.
Yes.
And why was that problematic? It's problematic because it may disrupt the functioning of the financial system if it becomes sufficiently prevalent. That's why it's problematic.
Run on the stock also disrupts the functioning of the financial systems. Company will be unable to raise equity capital. But we don't worry about it. We say just bear the losses.
Well, we don't typically think about runs on the stock because they don't engage in the kind of maturity, liquidity, and credit transformation that is so prevalent in the things that I'm talking about.
Okay, so where do you draw the line in bonds? Let us say 3 months, 1 year, 5 years.
Well, it depends on the risk. That's where I draw the line.
No, suppose there is run on a corporate bond fund, and the price dumps and the yields rise. Is that a run? I don't think so.
No, the price going down is not a run. A run occurs when the investors rush to withdraw their funds,
Yes,
right? That's what a run is.
yes. So they run on the corporate bond fund. The fund sells the holdings, its holdings. Price falls, yields rise. Is that a
And
run?
so what does the fund do in the event of when they see liquidations that they can't meet
They-
because they lack
They
liquidity,
liquidate.
Right, they
No,
liquidate.
What,
Or they
they
suspend.
cannot, no,
Or they suspend.
there is no such a thing that they cannot, they just sell their holdings and they get the cash and they redeem the.
So you're thinking about calm markets, I'm thinking about distressed markets.
Ah,
In distressed markets, what we know from Berner Peterson is that when you're having a liquidity mismatch in a fund,
Oh, no, their paper talks about margins, the mutual funds.
that's what I'm talking about.
Your mutual funds don't have margins, they just redeem, they talk about a different environment.
No, they're also talking about the title of the piece, it's called market liquidity and funding
Yes,
liquidity.
I know the paper,
And it's not just about market,
no, they say that
it's
they
about
are forced.
implicit as well as explicit market. And the point of the piece is that if you lack liquidity and you have to sell in a fire sale,
Yes,
that you will cause further downward pressure on the assets.
yes, but the same applies for stocks, I don't understand, why do you call it run, I would call it a severe loss on the holders. What is the difference between no liquidity in the stock, in a small stock fund, where they dump the units and the price falls and they take the money and they redeem the units, or a corporate bond fund, where they do exactly the same?
So open-ended bond funds are not as runnable as our money market mutual funds. Because money market mutual funds implicitly promise daily redemption at par. Implicitly.
Yes, but
Now, not the prime funds anymore because we've reformed that. Right? They have a floating NAV.
Yeah, but this is the minute adjustment. You'll have a floating NAV instead of breaking the buck, as it was then, and people will understand that, and that's it. It will be like any other fund.
So if these vehicles are used to finance economic activity or to finance other financial activity, that's where problems can arise. Okay. So,
Many other people.
If there's, would it be a useful distinction that you have a run because there's a clock game that's played out? The early people,
first mover advantage.
the early people get paid out in full.
Yeah, but this
And then
holds also in small.
But he would argue that that's true for stocks as well.
Same thing.
I think there's probably better liquidity.
Ah. Micro stock.
Okay.
Isn't there also some FDIC insurance and something like?
No.
Periodic.
Yes, there's implicit insurance for when there's stress and the government comes in to back them up, and we created a money market facility in COVID. That's the kind of insurance we're talking about. That's the kind of insurance that I think is creating moral hazard. Because it gets triggered when there's stress in order to bail out the people that Yaakov says ought to run but didn't. Right? And it saves their bacon. So when we think about the size of the runnable assets or liabilities, we think about money-like liabilities, and Yaakov, that's the distinction. Nobody would confuse equities with money. They do have a store of value, but they are not used as a unit of account unless you're keeping score in your portfolio.
Money is different, but you just told us that prime money market funds have a floating NAV.
Now they have a floating NAV.
Fine, this is a minor adjustment in regulation. You don't have to worry about one thing.
Well, the prime funds are still very runnable. And
Why?
the assets behind them are runnable because they don't have a floating. Okay. So the size of these liabilities relative to GDP obviously shrank quite dramatically after the financial crisis. And you can see that here. And you can see that one of the dominant features has nothing to do directly with money market mutual funds. But you know, they are important. But uninsured deposits are also runnable. They are not insured by the FDIC. And why would people want to hold uninsured deposits? Well, probably because they offer a higher return. Why would people want to hold repurchase agreements? Probably because they want to extend credit and they think they're going to get paid for doing that for people who need to borrow, and so on. So these things, and commercial paper, the same thing. In periods of calm, these function really well, but they contain hidden vulnerabilities. So the runnable liabilities have evolved over time. And one of the things that we often refer to the collection of these things as doing is being involved in shadow banking. That's a term that arose in the financial crisis. And it's loosely used often to represent all of market-based finance. But shadow banking is a narrower thing from my standpoint. It involves the creation of these money-like liabilities without an official backstop. Right? And so the instruments involved are money market mutual funds, repo, and commercial paper, and the institutions, money funds, broker dealers, finance companies, all of whom are important to the functioning of the financial system. Now, two key developments since the great financial crisis, I think, are important in this regard. One is the growth of non-bank financial institutions who are asset managers, like open-ended bond fund managers. And often, maybe explicit, but not always, with leverage. The second is that we really dismissed the use of unsecured financing because it proved to be problematic. It proved to involve credit risk. And so we now use collateralized financing to reduce or eliminate counterparty risk. And that works well, except when we have collateralized financing, we translate counterparty risk into liquidity risk. We saw that in the LDI episode in the UK. We've seen that LDI, liability-driven investing. When the pension funds in the UK saw that rates were rising, ironically, they became better funded, as you would expect for a pension fund, right? Rates go up, the pension fund's liabilities shrink, right? And so you would expect that meant they were better funded. Unfortunately, they used total return swaps or other swaps, and they used leverage in order to achieve their funding obligations, because it looked cheap and was easy to do at the time. And when rates went up, those positions and those, especially the leverage ones, really triggered the fire sales that I mentioned about earlier. And so the Bank of England had to come in and purchase bonds, gilts, in order to minimize the damage to the UK financial system.
I just wanted to see if I could reconcile sort of your back and forth with Jaco, which is that it seems to me that a lot of the assets in the economy are always being leveraged one way or the other. Sometimes the primary originators of risk are leveraging on their balance sheets. Sometimes those who are not the primary owners, but they could take contingent liabilities and then they are leveraged up. And so I wonder if, even if something is just like an open-end mutual fund, if there is a dash for cash, as you said, and it leads to price impacts and volatility, it will then trigger leverage-related margins and other distress.
It will expose the leverage that's there.
And so I wonder if that's sort of like the extra step, which is that price impacts and volatility will trigger margin calls and leverage-related issues. Elsewhere in the financial system, it may not necessarily be that the concern is just with the fund itself. It's with the spillovers that are going to arise from
That's a helpful point, because what we need to do is look at this from a system-wide perspective and think about what the spillovers are from the change in asset prices to positions that may be leveraged in other parts of the financial system.
Excuse me, I'll just also one thing, just about trying to figure out what's going on. I think you're making a big step going from a money market, a money fund, which is a deposit-like asset, and we think it behaves like cash, to a bond fund, which I think I agree with Jacob. I don't think there's any difference in selling the underlying bonds versus selling the fund. Whereas a money market fund is quite different because people are viewing it as a deposit and it has a longer term thing. So I think when you take the step from a money market fund to a bond fund, you run into the Yakov critique. So that's my point number one. My point number two is I think what happened in the UK is an example of a regulatory failure, not a market failure, nothing to do with runnable assets. What basically happened is before the financial crisis, banks were allowed to talk to pension funds. And they say, you know what, you're getting even though you're kind of hedged, your swaps are coming, it's an NPV relative to us, you have to give us some collateral. You have a few weeks, you have a month, you have to do that. We didn't require before the financial crisis that pension funds be variation margin every single day to the clearinghouse for the clearing of swaps. And that we set up, which I thought was a big mistake, and I wrote about it, 2015 or before that, to require. So that's what you said in terms of counterparty risk and liquidity risk. So that particular example is something that I think we've created and is not
No question.
markets that we need to fix.
100% agree with you. Disagree with you on the first point, because there's liquidity and maturity mismatch going on in the open-ended bond fund.
I don't see that.
Okay, we'll come back to
You
that.
got bonds. Don't have.
We'll come back to that. In addition, the most interconnected institutions on the planet, namely CCPs, are particularly prone to this issue of turning counterparty risk into liquidity risk, right? And that's because that's the process of central clearing. It makes the CCP the buyer for every seller and seller to every buyer. And so instead of eliminating the risk, we concentrated at the CCP. And, unfortunately, there's a regulatory failure there because the incentives are not aligned, or at least haven't been up to this point, to have the CCP assume some of that risk. Instead, it pushes it onto the clearing members. But let's talk about what the implications of runnable collateralized liabilities does for creating vulnerabilities in these markets that are so important for the rest of the financial system. So to Yakov's point on money funds, we did have some reform, but the money funds still mismatch liquidity and maturity on the assets and liabilities, right? And in March 2020, we saw prime and tax-exempt money market mutual fund redemptions amplify the stress in money market, without question. So we've come back to talking about what the reforms ought to look like in those parts of the financial system. And we see what happened after the reforms. Obviously, prime funds, which now have a floating NAV, declined a lot. Government funds increased a lot. These are just the two categories. Money funds have continued.
Excuse me, can you walk us through the plot, because I don't see?
Sure. This pink area is the prime funds, which prior to reform in 2015 were about $1.7 trillion, right? And that's all prime funds. The prime institutional funds declined very significantly from more than 1.3 trillion down to about 0.3 trillion.
What is the difference between the two?
One was held by institutions, one for cash management purposes, the other held by retail or individual.
Okay, so the light purple is the individuals and the red is the institution.
Over here, you're looking at, I don't know if you can see, yeah, over here, you're looking at the total. And here's the breakout, which we didn't have data for prior to the reform. We only started collecting
So
those.
the dark red is the institutions.
The dark red is the prime retail,
Oh, prime. Okay.
okay? And so now that it has the floating NAV, and you can't get you're not promised.
So the one that's looking more red, I don't know what is dark.
Yeah, the one bottom.
This one at the
Yes,
bottom,
that's-
that's institutional.
Okay.
So by the way, I think the retail does not have a floating NAV. It's only the institutional that has a floating NAV.
I believe that's
That's number one. And number two, the big drop was not because we did a fee, it was because
Can you clarify? You said.
the retail still has a fixed NAV, $1 per share.
A buck, per unit.
Yeah,
they weren't required to float.
only the institutional funds.
Because the retail didn't run very much, is my understanding.
And also, it's just completely, it would make the product completely unsustainable for retail people. But the reason why we had the big drop was not because of the NAV, but because of the gates that could be imposed. So part of the money market reform was that these funds could put down gates and say, hey, if we don't fill out liquidity tests, then we can just stop redemptions. They weren't able to do that before.
That was definitely a factor.
And in my mind, that kind of killed. I was amazed. I was preaching that the product would die completely. I'm amazed it came back. But the whole point of a deposit-like thing is you can get your money out of it. So anyway, so what
is the gap? How severe is the gap?
if you can
Stop
stop
redemption.
you can just stop. You can
How long?
first you can impose a fee, transaction fee in the first case, and then if you go further into the liquidity things, you can actually just stop redemptions until you restore the liquidity of the fund. And that makes it very undesirable.
So the interesting thing is that in the 2 weeks in mid-March, these are monthly data, by the way. That's the only frequency we have. In the 2 weeks in mid-March, the institutional 2020, the institutional money market mutual funds lost 30% of their assets. That wasn't because of the NAV changing. It was because people feared that they wouldn't be able to get their money out. So I agree with Bruce on that score. Right? And so that's the definition of runnability. People wanted to get out before the door slammed shut. When we saw the pandemic shock, it produced what is now widely known as the dash for cash. And to me, that was the result of increased liquidity demands, which the system was unable to accommodate. What's the evidence for that? Instead of seeing declines in interest rates, we saw spikes in interest rates and secured funding areas.
You mentioned the treasury spike. I was just looking at the Nagel paper on the treasury convenience seal in March 2020, and they in the end attribute to the supplementary leverage ratios. They're so costly to intermediate, and so kind of comes back to some of the regulation that was put in GFC then came to hit us even within the very safe treasury trade. So
One of the remedies is to recalibrate your supplementary leverage ratio so that it doesn't discourage this kind of activity, right? And that's commonly accepted now, and it was put in place temporarily during the crisis to enable banks to better intermediate the demand for liquidity, right? So was that a cause or was that the result of the shock? The supplementary leverage ratio amplified the problem because it limited the supply and banks wanted to hoard their liquidity. So there was less supply, but the demand shock, what was the demand shock the result of? Well, we had spiking offshore dollar demands. We had a huge widening in foreign exchange basis swaps. We had sales from foreign official holders of treasuries who needed to raise cash. And that also impaired treasury markets. Bid-ask spreads in off-the-run treasuries widened considerably. We had the treasury cash futures basis change dramatically. And there was huge decline in market depth in the treasury market. And of course, haircuts reflecting what you might call margin calls jumped at CCPs in a very pro-cyclical way because the CCPs weren't about to take the risk. They wanted to push it onto their clearing members. And as Viral has pointed out in his work, non-bank financial companies also drew down their credit lines, further amplifying the liquidity stress. So, yeah.
broadening the regulatory umbrella wouldn't have really solved it that time. You see,
Broadening the relative.
yeah, you need to have a broader, there's all this unregulated parts that
Making
this
money
issue
markets
that you're
more
bringing up
resilient.
here.
Yeah, making money markets more resilient would have reduced the stress. And so when we think about the reform, and I'm going to jump ahead here, but here, just quickly, here's some charts that illustrate sort of the 99th percentile for the secured overnight financing rate, the SOFR rate, that shows that those rates jumped right around the time of the financial crisis. That's the light blue line. You can see foreign exchange swap implied basis jumping from less than 50 basis points to 200 basis points, the cost of borrowing via swaps in US market. Yeah,
Given the severe changes that Bruce was talking about, where did the institutions park their money once they went into effect? There are hundreds of billions of dollars.
well, you have to ask, I mean, they parked it in a variety of ways. Why did people draw down their credit lines at banks, only to put them back in the banks as deposits, earning a negative spread? Why did they do that? Because they prized the liquidity so highly.
So the money that was withdrawn or was not channeled to the money market funds of the institutions.
Went into banks.
Went into.
Banks had more deposits than they wanted, Jakob. They actually contemplated at one point offering negative interest rates on deposits because they had many more than they could make use of.
But
I agree with that, but it also went into government-only money market funds.
No, but.
So they went out of prime money market funds, which you could invest in corporate securities, into government-only money market funds.
Oh, okay.
So it was that plus the
Treasury.
banks, yeah.
Treasury.
Mattress cash, right?
I think at the last VRI board meeting, I thought one of the board members, Ken Berner, made a very interesting point, which is, and I think was also very followed by BlackRock. I think it goes back a little bit to this discussion about volatility and all. They basically said that even as very large intermediaries, they just said that at some point when the markets are crashing so badly and the volatility is so high, they don't think of it as arbitrage. They don't think that they don't know that they can actually step in, buy, and come out unscathed.
Why should they take the risk?
Yeah, because they also have some leverage, some institutional, constraint, which is.
Remember, the banks are still levered 10 to 1 at a minimum, right?
So the institutions that are not benefiting from the FDIC, they are subject to risk. So why do they put their money in the banks? The banks can also go under and they lose. They don't have any insurance there.
Because if you put your money in JP Morgan, you know that the authorities are gonna bail them out. They're not gonna let JP
Oh, I
Morgan
see.
fail.
The
So you're on safe.
The sickness game in power.
Yeah.
Right. Okay, so bid-ask spreads also.
You're on the paper.
Do you have some specific proposals? I'd love to hear those.
I do. So they relate to these systemically relevant markets. And what we need to think about is ways to limit the demand for liquidity and stress and ways to improve the supply of liquidity and stress. And if there are more liquidity shocks coming, then we need to address those. This just illustrates the shrinking role of broker-dealers in the financial system, which is pretty well discussed. So how can we improve both of those, and what's the role for central banks? We need a system-wide approach. This just emphasizes what we saw before, which is that there are system-wide problems and spillovers from one part of the system to another, and the mismatches, and some of the constraints to Thomas's point. Some of that came from the fact that the SLR and the ESLR in particular discourage repo activity at banks. But what we think of as liquidity also, and this is important for thinking about reforms, there appears to be on a daily or intraday basis liquidity coming from principal trading firms, aka high frequency trading firms, and more complex intermediation chains, which spreads the liquidity risk across the system. So that's where you get the Berner-Peterson kind of dynamic in the system. And then the moral hazard from the central bank's response is not just limited to banks, far from it. We bailed out the financial system through the Fed's actions. So the first line of defense here is to make the institutions, the infrastructure, and markets more resilient. That's always the first line of defense. The last line of defense is to strengthen backstops that we have to provide liquidity. Those should be used in extremis. Those should be used, however, with appropriate governance, and those should be used in times of real stress. We've done some work on that We created a standing repo facility from the Federal Reserve. Unfortunately, it's very limited in scope.
Who is we?
We, the regulator.
Which?
Well, this in particular, the Federal Reserve has created the standing repo facility. Right, but it's only available to primary dealers and to depository institutions. To address the dollar liquidity problem or issue, we've created this permanent dollar swap facility. The FCC has proposed central clearing. Central clearing, to my way of thinking, doesn't by itself provide more liquidity. In fact, it may create less or more demand for liquidity when you put more on the platform. And helpfully, a proposal to improve governance and risk management of CCPs. There are other proposals, which include the permanent exclusion of reserves from the SLR. And that should be done by recalibrating those ratios so you don't lower capital requirements. Better information on uncleared repo, particularly bilateral uncleared repo. With central clearing all-to-all trading to broaden the access of participants to trade with each other. And to broaden the standing repo facility and to have centrally cleared repo. All those are useful as long as they all work together. On the demand side, to limit the use of leverage in non-bank financial institutions. And to have other issues, other ways of addressing the liquidity mismatch in money market mutual funds. So I have a few that I would add to that. First of which is improving governance and accountability for financial stability regulators, which we really don't have. The second involves improving disclosure and reporting at non-banks, to Ed's point, and for important markets such as uncleared bilateral repo. Third, to have a minimum floor haircut regime for repo and securities financing transactions, which we've talked about forever, but which hasn't been implemented. It's not easy to do, but we want to reduce procyclicality in the financial system. That's one way to address that. I agree, broaden the Fed standing repo facility and improving liquidity, stress testing, recovery, and resolution of CCPs so that they are more accountable for and can better manage their risk. So that's my proposal. Now, when we think about the governance for backstops, we ought to think about two aspects to that. One is for the traditional lender of last resort, where we need to have much clearer objectives, not to make it up on the fly when bad things happen, and strong conditionality to limit moral hazard, and what the prices ought to be for that. And when we think about the market maker of last resort, which is related but not the same thing, we need to think about which markets are really important, and to say that we're going to protect those markets, and the quid pro quo will be increased oversight and supervision. VRI actually, in his comment on Metric and Tarullo, made this comment in Brookings papers in 2021. And then make sure that when you do interventions, that they are self-limiting, and you announce in advance that they are self-limiting. That was one virtue of what the Bank of England did when it came into the gilt market. They said, we're out on Friday, and you guys are going to be on your own. And so you better get your act together before that time happens. And then making sure that when you offer these things, that the risk is appropriately priced. On time. End of seminar.